Look, as a professional investor, I spend pretty much my entire day staring at actual numbers, trying to separate the shiny marketing from cold, hard economic reality. And let me tell you, lately, there is a whole lot of shiny marketing out there. So, in today's explainer, we're going to dig into the real data behind the financial illusions being sold to us online and by politicians.
I mean, we've all seen these viral promises popping up on our feeds, right? Influencers claiming they magically turned a tiny tax return into a six-figure fortune in a matter of months. It fuels this totally insatiable desire for instant wealth without actually putting in the work. They're selling a lavish lifestyle supposedly funded by guaranteed returns on a couple of lucky stock picks. And yeah, it sounds absolutely incredible.
But that brings us to the big question for today, and really the lens we're going to use for this whole deep dive. When somebody pitches you a get-rich-quick scheme online, or a world leader pushes a heavily oversimplified economic policy, are they handing you a true shortcut to wealth, or are you just buying into a very dangerous mirage? Here's our roadmap for today. We're going to move from the micro-level retail trading casino right into sovereign funds, crunch the math on secession, do a quick reality check on tariffs, and finally, look at how global shocks actually impact markets. We're unpacking the hidden complexities at every single step. All right, Section 1, the retail trading casino. Let's talk about platforms like Polymarket. They pitch themselves as this foolproof way to trade your way to financial freedom. The promise is that you can just harness the wisdom of the crowds and make easy money off your unique insights into the news. But the reality? It's a whole different ballgame. You are competing in an environment absolutely rife with insider trading and market manipulation. And the way these contracts are set up, if you bet on a highly probable event, your upside is heavily capped, but your downside? Always 100% of your investment. The risk is incredibly asymmetric. Despite all the influencer hype telling you to just copy the top traders, look at the actual hard data here. 84% of Polymarket users are taking realized losses. The median return on investment for retail users, -8%. And out of 2.5 million participants, an astonishingly low 2% have ever earned more than $1,000. Spoiler alert, this isn't an investment cheat code. It's a casino. And the house, or in this case, the highly sophisticated institutional trader, almost always wins.
Moving on to Section 2, sovereign funds and retail risk.
Now let's pivot to a different kind of pitch. This one's actually coming from a national level. Take Canada's newly proposed Canada Strong Fund. Prime Minister Mark Carney is proposing a sovereign wealth fund kickstarted with $25 billion. But what's super unique here is that it actively invites everyday retail investors to jump in on domestic infrastructure projects right alongside institutional capital. The government is even floating the idea of guaranteeing investor capital, kind of like a bond. On paper, investing in your country's growth with a guaranteed floor sounds great, doesn't it?
But here is the catch. And as an investor, this is what I always look for in the fine print. Liquidity risk. Unlike trading a highly liquid stock on your phone, investing in a billion-dollar bridge locks your money up for a very long time. We're actually seeing this same exact trend with private credit funds being aggressively marketed to retail investors right now on social media, promising fantastic, supposedly guaranteed yields. But here's the dry reality. When markets inevitably take a turn, these private funds gate their withdrawals. You can't just tap sell to cash out and go buy a latte. If you actually need your money sometime this decade, you might be totally out of luck. And this is exactly why comparing Canada's pitch to Norway's wildly successful $2 trillion fund is, well, magical thinking. Norway actually funds its investments using a massive budget surplus from fully nationalized oil. And critically, they invest exactly 0% of their fund inside Norway to avoid concentration risk. Canada, meanwhile, runs a budget deficit, relies entirely on private oil royalties, and plans to sink 100% of this fund domestically. The basic fiscal math and the risk profiles aren't even in the same universe.
Section 3, the math of secession.
Zooming in on provincial movements, let's take a hard, skeptical look at the economic promises of the Alberta separatist movement. We constantly hear these sweeping promises of lower taxes and massive prosperity if the province just breaks away. Secessionists point to this huge claimed budget surplus, around $35 billion, if they stop sending cash to the federal government. But when you look at the actual data, it completely dismantles this oversimplified math. It totally ignores staggering hidden costs, like a mandatory $10 billion annual military budget just to hit baseline NATO targets, and a $20 billion hit to their economy from trade friction alone. When you actually look at the facts impartially, the promised financial utopia starts crumbling pretty fast. Their surplus math just assumes they can commandeer up to 50% of the entire country's pension plan.
and it conveniently ignores the $10 billion they'd need to replace federal child benefits and old age security. Plus, becoming a landlocked, independent nation means entirely renegotiating trade access. You're risking a 2 to 5% drop in GDP strictly from new non-tariff trade barriers. It's the ultimate example of selling a simple, guaranteed return while hiding the catastrophic tail risks.
Section 4. The Tariff Reality Check.
Let's jump into international trade. Tariffs are almost always pitched as this super simple way to protect domestic industries. But look at this timeline. It perfectly demonstrates that tariffs are practically never a simple fix. In August 2024, Western nations slapped a 100% tariff on Chinese electric vehicles. The retaliation was almost immediate. China slammed tariffs on Canadian agriculture, absolutely devastating the canola export market. By early 2026, the economic pain forced a total pivot, with Canada agreeing to a new trade deal that reversed the EV tariffs just to get their agricultural market access back. It's a cascade of retaliations. It is not a simple cheat code.
Now get a load of this number. Literally, $175 billion. That is the massive amount of revenue the U.S. collected through President Trump's IEPA tariffs, and the Supreme Court has now abruptly ruled that entirely illegal due to a lack of congressional approval.
Global trade law is, to put it mildly, a massive mess. Sure, returning those illegally collected funds might actually cut consumer inflation tied to tariffs in half, dropping it from 1.2% down to 0.6%, but it opens a total Pandora's box. Huge corporations are gearing up for years of intense litigation to claw their money back, which leaves a gaping hole in the federal budget. So how did the White House patch it? They immediately retaliated by slapping on a new, temporary 10% baseline tariff using totally different legal statutes. The illusion is that a court ruling ends a trade war. The reality is that the goalposts just get moved.
Section 5. Global Shocks and Market Realities.
Finally, let's look at how geographically isolated events prove that there are absolutely no simple fixes in a globally connected economy. Following the recent joint U.S.-Israel military strikes on Iran, dubbed Operation Epic Fury, the economic fallout is stretching way beyond the Middle East. You might assume that because Iran is already heavily sanctioned, the global economic impact wouldn't be a big deal.
But that assumption totally ignores geography. Check out this Strait of Hormuz here. It's a waterway bordering Iran, and it's barely 33 kilometers wide at its narrowest point. Yet, 20% of the world's seaborne crude oil and 33% of the world's urea fertilizer flows right through it. Just the mere threat of closing this tiny little choke point instantly endangers a massive chunk of the entire planet's energy and food supply chains.
The big takeaway? A regional conflict almost instantly creates global economic casualties. Right after the strikes, West Texas Intermediate crude spiked over 30%, pushing $90 a barrel. European natural gas futures skyrocketed 60%. Marine and airline insurance companies started outright canceling coverage for war risks in the region, which strands freight and makes shipping costs go completely parabolic. This translates directly into higher inflation and an economic shockwave that hits the wallet of average citizens everywhere. You simply cannot escape the interconnectedness of these markets.
So, which brings us to our final takeaway. As you scroll through your feeds, whether it's a TikToker hyping up a guaranteed stock market return, some apps selling you the wisdom of the crowds, or slick online ads pushing high-yield private credit, I want you to think about this. Are you going to keep seeking out simplistic cheat codes? Or are you going to rigorously question the data, look out for that hidden liquidity risk, and understand the complex realities of global finance? Keep a healthy dose of skepticism. Always check the fine print before you hit invest, and I'll see you in the next explainer.